Hey everyone, and welcome back to the show. Today, we're diving deep into a financial giant that most people might not fully understand, yet it's absolutely massive. We're talking about futures.
That's right. When you look at the sheer notional value, futures trading actually surpasses the colossal foreign exchange market. It's truly one of the largest, most active trading arenas on the planet. I mean, it's often called the king of financial products for a reason.
It's fascinating, isn't it? Such a seemingly simple core idea, yet it morphs into these incredibly complex strategies and diverse trading tactics across the financial world. So, what are futures on the surface? What's their real essence? What are their unique characteristics? And how do they really create all this financial magic?
Let's start with the basics. The full name is a futures contract. Think of it as an agreement between two parties. They commit to buy or sell a specific asset at a predetermined price, but on a future date. For example, let's say I, speaker 2, decide to buy a December 2025 gold futures contract at $3,000 an ounce. And let's assume one contract covers 100 ounces of gold.
Okay, so you're committing to buy in the future. What about the other side?
Exactly. So I'm the long side. The other party, the short side, let's call them speaker 1, they're committing to sell me 100 ounces of gold at $3,000 an ounce on that December delivery date. Now, if the market price of gold drops to $2,000 by then, I'm still obligated to pay $3,000, so I lose $1,000 per ounce. But if gold rockets to $5,000, I still buy at $3,000 and I make $2,000 per ounce, while speaker 1 takes that $2,000 loss.
So it's a future commitment, and the variables like the expiration date and the underlying asset are all predefined in the contract. And then these contracts can be freely traded on an exchange.
Precisely. And the interesting thing is, traders usually don't even know who they're trading with. This simple future commitment is the core idea. Very similar to buying and selling gold today, but you're just agreeing to do it at a specific point in the future. That's why, in their early days, futures were mostly used for one primary purpose: hedging risk.
Ah, hedging. That's a key term. How does that work in practice? Give us an example.
Sure. Imagine I'm a wheat farmer. I'm spending money now on seeds, fertilizer, rent, and I won't harvest for 6 months. What if the price of wheat crashes by then? I'd be out of pocket. So I can short wheat futures for, say, 6 months out. This locks in a selling price now, protecting me from a future price drop. Conversely, flour mills, bakeries, breweries, anyone who needs to buy wheat constantly, they fear price spikes. So they can long wheat futures, locking in their future purchase costs.
So it's a form of insurance, in a way, against price volatility.
Exactly. Airlines can long jet fuel futures to hedge against rising fuel prices. Gold jewelry manufacturers might long gold futures, while gold mining companies might short gold futures to protect their revenues. You can even see major corporations like ExxonMobil. Their annual reports show they consistently hold short positions in natural gas futures to manage their exposure.
It sounds like a fundamental risk management tool then. So for many commodities, there's not just a spot market, but also this parallel futures market, with contracts expiring every month, all actively traded. And you're saying their prices are generally very close to the spot price, right?
Yes, they're typically very close. While there are subtle differences due to factors like interest rate discounting and risk premiums, which, by the way, many hedge funds and brokerages exploit, for most investors, you can generally think of futures prices and spot prices as being almost identical. So if you think gold prices will rise in 6 months, instead of going through the hassle of physically buying, storing, and selling gold bars, which is cumbersome and costly, you can just buy gold futures. They'll track the price, and you just sell the contract before its expiry. You profit from the price movement without ever touching the physical gold.
That's a huge distinction. The ability to closely track a commodity's price without physically delivering or taking delivery really expands the market. It can't just be producers and consumers driving the trillions in daily trading, can it?
Absolutely not. This is where speculation comes in. Take cocoa futures earlier in 2024. They surged from 4,000 to 12,000 in a few months, a 200% jump. Why? A massive wave of hedge funds poured in $8.7 billion betting on the price increase by longing cocoa futures.
Wow, that's a huge bet on chocolate. What was driving that?
Cocoa, the raw material for chocolate, is a significant market, with over 5 million tons produced annually, mainly from Côte d'Ivoire and Ghana. Late in 2023, reports emerged about heavy rains in Côte d'Ivoire, bad for cocoa tree growth. More critically, a fungal disease called black pod disease was devastating cocoa farms. Hedge funds analyzed this, realized it would drastically cut future cocoa yields, and flooded the quiet cocoa futures market. These weren't typical commodity traders. They were speculative capital, pushing the price up threefold.
So they just saw an opportunity to profit from a potential shortage.
Exactly. Hedge fund capital eventually accounted for over 85% of the long positions in cocoa futures. And they were right, the spot price did surge. But it's not just pure speculation. Hedging still plays a part. Think about chocolate manufacturers. Rising cocoa prices would normally crush their margins. But a major player, Hershey's, had hedged by longing cocoa futures. So when prices exploded, their futures positions generated over $500 million in revenue, offsetting their increased raw material costs.
That's a brilliant example of how both speculation and hedging can coexist in the same market. Now, we've talked about futures tracking commodities and even gold prices for hedging or speculating, but I suspect there's a much broader application beyond physical goods, right? What's the 1.0 version versus the evolution?
You're spot on. Futures aren't just for oil, soybeans, or gold. That's just Futures 1.0. They can track virtual assets, financial assets. For instance, stock futures are contracts to deliver shares. Treasury futures deliver government bonds. But here's where it gets really clever. Futures can track any abstract index or number, even one that seems completely intangible.
An abstract number? How does that even work? How do you deliver a number?
Great question. The biggest category of futures globally is actually stock index futures. You're not delivering specific stocks, you're just tracking a numerical index. For example, if I go long an S&P 500 futures at 6,000 points set to expire in December, if by the expiration date, say the third Friday in December, the S&P 500 index hits 10,000 points, I've made 4,000 points. The clearing platform then just directly pays me the cash difference.
So no physical delivery at all, just a cash settlement based on the difference between the agreed price and the actual index value at expiration. That's a game changer.
Absolutely. This is a crucial evolution for futures. Theoretically, any objectively quantifiable metric, any number you can bet on, can become a futures contract. An exchange can just create a contract for it. I mean, we could even create a Speaker 2 Video Views futures contract.
Laughs. A Speaker 2 video futures, I'd buy that. But how would that even work?
Well, we define the settlement metric, maybe my total video views across all platforms in the last month divided by 1 million on a specific date. If my views are 50 million, the index is 50. Then people would trade that futures contract based on their predictions. If my channel takes off in September and October, people would bet December's numbers will be even higher, and the price of the futures contract would surge. It's a silly example, but the core point stands. Everything quantifiable can be financialized through futures.
That's an incredible insight. Everything quantifiable can be financialized. So you can bet on oil, gold, bond prices, interest rates, or even, hypothetically, your video views. This flexibility, along with some other key features, is why futures are considered the king of financial products. What are those other key features?
Well, the futures part means there's a maturity date, a delivery rule, which keeps the futures price tied to the underlying asset. But the reality is, most futures traders never hold until expiration. They close their positions beforehand. Less than 1% of global crude oil futures, for instance, actually result in physical delivery. Most people are just betting on the price movement.
So they're pure price bets with no intention of actual delivery.
Precisely. And some products take this even further, like perpetual futures often used in crypto. They literally have no expiration and no physical delivery. They just use a fee mechanism to keep the futures price aligned with the spot price. So they drop the future part entirely, leaving just the perpetual contract, purely a bet on price.
That's extreme. Okay, beyond that, what are the inherent advantages or characteristics of futures that make them so powerful?
There are three big ones. First, high leverage. To buy $100 of stock, you typically need $100. With margin, maybe $50 for a 2x leverage. But with futures, you might only need $5 to control $100 worth of a contract. So if you have $100, you can control $2,000 of futures. That's 20x leverage. Very little capital can control huge market exposure.
That's a lot of power. And the second?
Second, ease of shorting. Going long or short is just a directional choice, like turning left or right. Shorting stocks is complicated. You have to borrow shares, sell them, then buy them back later, with many regulations and borrowing limits. Futures, however, are simply a contract.